I lost $40,000 trading options in a single day, and it was absolutely worth it. I learned three things from these massive losses, and I want you to reap the benefits of the learning lessons so you can avoid taking losses like this. If you're new here, welcome. My name is Mo. I'm a full-time options trader and an educator. I've helped close to 5,000 people secure freedom in their lives by turning them into profitable traders over the course of 5 years. In this video, I'm going to reveal three lessons that I've learned from losing $40,000 in a single day so you can avoid mistakes that I've already made. By the end of this video, you're going to know exactly what not to do so you can keep your losses small and continue to grow as a trader. I'm also going to share an action plan so you can truly implement everything I share with you so it's not just theory after you watch this video. All right, let's get into it. So the first lesson I learned from losing $40,000 in a single day was that I had poor risk management, or shall I say, I had no risk management. I did not know where I would exit if I was wrong. I did not know where I would take my profit. So the simple hope was that the market might keep going up, which would mean that I would make profit. Now going without a plan might seem like not a big deal, but when things go wrong, oftentimes going without a plan means you can take max losses, or worse, you can take a big hit on your confidence and execution style. Now, the second thing that I learned from losing $40,000 a single day was that I was in too many trades. In simple terms, I was over leveraged. I had 10 different trades, and the mentality was that because I have a big account, I did not feel comfortable putting all my money in one trade. So what I did was took a bunch of small trades, and as my FOMO grew, I added more trades. And at the end of the day, I had close to 10 single trades. The problem with this logic is that all my 10 trades were in tech, which meant that when the market pulled back that day, every single trade of mine was red. And in my head, I thought I was diversified because I was in different trades, yet I had all my money in the same sector, which was tech. Now, one of the reasons why most of us do this is when you grow your account from a small account to a large account, you don't feel comfortable scaling to a larger position. So if you went from a $500 account to, let's say, 10,000, you're now going from a $200 position to, let's say, 5,000 or 2,000. Most people don't do that because they're not comfortable. So what they'll end up doing they'll do more of those $200 positions because that's the amount they're comfortable with. And what that leads to is over leveraging either in the same sector or just over leveraging your decision making, because now you have 10 different charts, 10 stop losses, 10 stocks to watch in terms of what news might impact or what sector or what political view might impact your stock. So being over leveraged means that you have to make the decision very fast because there's no room for error. See, my mistakes or lessons compounded one after another. Imagine going in an over leveraged position, market pulls back, but you don't have a plan if that happens. So it's basically a recipe for disaster, which leads to my third lesson that I learned after losing $40,000 in a single day. See, most of my losses didn't happen that day. They happened after that day. That's because I started revenge trading. Every day I'd wake up after that day wasn't about taking the best setups. It was looking for opportunities where I could make up for the money that I've lost. And part of that was because I didn't take any accountability for those losses, and I blamed the market, because one of the things we saw in 2020 was the market go up. What we didn't see was rotation. So around July, we saw rotation from where the money went from tech into other sectors like banks and retail, which I found unfair because, of course, I had no accountability, and that led to what I call revenge trading for the next month. Now, these three things combined, or these three lessons combined, compounded and made the problem much bigger. And having a poor mindset and revenge traded added on top of that. Now, it's not just enough to know these lessons. If you really want to become a profitable trader and avoid mistakes like mine, you have to implement these lessons. So I put together an action plan that you leverage immediately after this video. Before I break it down, I want to mention that if you found this video valuable and would like to see more of this, make sure you like, subscribe, and share. All right, so the best way to implement this is broken down into three key steps. Number one is risk reward. You only take trades where you have the risk reward clearly defined. My perfect trades, which I call them A plus setups, have a risk reward of 1, 2, 3, which means if I'm right, I'm going to make $3 on the stock. And if I'm wrong, I'm going to lose $1 on the stock. So when I'm analyzing these stocks, I'm marking the chart with my entry, my stop loss, and my profit taking, which gives me an exact risk reward setup. Let me go over a quick example to show you how that's done. So this is based on an actual trade that I took today. Let me show you the trade quickly before I get into the actual reason why I took it. So the trade we took today was Tesla 290 at 2.75. And these are weekly, so they're high risk, but I'm going to show you why I took this trade. My entry on this trade was around this level here. I always mark my entry a yellow. My stop was the low of the day. My first profit taking was this level here. Now, before I got into the trade, I had all these levels marked. And what I do here is I run a risk reward analysis on this, which is simply creating on this link called projection on TradingView. And what we're doing is marking where our entry, stops, and profit taking is. And so based on this setup, this trade idea gives me a risk reward of 4.28, which means if I'm right, I'm going to make 4.28. If I'm wrong, I'm going to lose $1. Now I'm up considerably on this trade, almost up 80% on this trade right now. But what I want to talk to you about is regardless of what the profit is, this is my process. And this is how I take every single trade of mine. So anything I'm teaching today is something that I'm also living day to day on my Discord. Now, when you take trades with a risk reward of 1, 2, 3, two things will happen. Number one is you're going to take very few trades because a lot of those trades will not give you a setup which gives you 1, 2, 3 risk reward ratio. Most people are taking trades without even knowing what their risk reward is. The second thing that's going to happen is you're going to avoid over trading. And so because you can only take few trades because they don't match your criteria, it just takes FOMO out because you know specifically why you're not in that trade. Now, the second thing that you need to implement if you want to be a consistently winning trader is manage your position size. Your position size is directly tied to your emotion. If you have too big of a position, you're going to be emotional. If you have too small of a position, you're not going to care because it's not going to yield you much profit. So make sure you identify what your risk tolerance is. Once you have identified that, you decide what your position size is going to be. So I'll give you an example. Let's say your account size is $50,000, but you don't feel comfortable trading more than $500. If that's the case, you shouldn't have 50,000 more in that account because at the end of the month, it's not going to reflect the right profit percent because eventually what it's going to start looking like is you're only making 5 to 10% profits in a month. What you want to do is have it sized properly. At the same time, you don't want to have different position sizes for different trades. You want to have a range based on low probability to high, but that's where I would keep it. Now, trades that have a very high reward and very low risk, you could size a little bit more, but just a general rule of thumb, you want to have a consistent position size so you can track what you're doing right and what you're doing wrong, and any improvements could be made, so forth. The third thing that I talked about was also my lesson was I was revenge trading. The only way you can avoid this is if you have the right mindset. Now, when I showed you the Tesla trade, I told you don't focus on the profits, focus on the process. A lot of time in trading, you're going to be rewarded for things that aren't done right. So a lot of people play high risk trades, they play earnings. You might get lucky and end up making money, but you're not going to be successful consistently doing that because your focus is profits, not the process. And so consistency comes from things that you can scale. That only happens when you follow a process. So always make sure your mindset is right. And if any point you feel like you're not doing okay or you're emotional, don't take a trade. Just wait a couple of days, take a break, and that'll really help you stay neutral when you're getting in a trade. Now, if you combine all these three things that I've talked about today, over time, these are going to compound not only your profits, but your confidence and your knowledge with your execution. You have everything you need. Now take action for the life you truly desire and deserve, and make sure you follow and subscribe for more.